Imagine hiring a personal trainer who secretly gets a bonus every time you eat a donut. Sounds ridiculous, right? Well, in the financial world, something similar can happen. Not all financial advisors are required to put your interests first. Hi, everybody. I'm Christos, co-founder of Caplytica, where our goal is to give you the tools and knowledge to turn investing into a shared skill. By the end of today's video, you'll be able to answer the question, is my financial advisor acting in my best interest? You might be thinking one of two things right now. Maybe you're starting to feel a little uneasy, wondering if you should have done more homework on the person you trusted with your money. Or maybe you're thinking, there's no way my financial advisor could actually take advantage of me. Something like that has to be illegal, right? The answer to both of those thoughts comes down to one word: fiduciary. First up, what does fiduciary mean anyway? Simply put, a fiduciary is legally and ethically obligated to put your interests ahead of their own. If an advisor is a fiduciary, they must give you advice that's best for you, even if it means less money or convenience for them. In contrast, many financial professionals are held only to a suitability standard or a watered-down best interest rule, meaning they can recommend products that are okay for you, even if there are better, cheaper options available. For example, a non-fiduciary broker might sell you a mutual fund with a 5% commission when there's a no commission fund that would suit you just as well. Over time, those costs compound and can cost you thousands of dollars or more. It's like that dodgy mechanic who tries to upsell you on air filters and blinker fluid every time you go in for an oil change. In the financial world, a fiduciary is more like a fee-only consultant with no incentive to upsell, whereas a non-fiduciary might be more like that commission-based salesperson. The term financial advisor isn't tightly regulated. Anyone can call themselves a financial advisor. They might be an insurance agent, stockbroker, or investment advisor. Only those who are registered investment advisors or the representatives of one are true fiduciaries by law. So it's on us as investors to figure out who's who. The last thing you want is to assume you're getting unbiased advice when you're not. So let's talk about how you can verify your advisor's credentials and fiduciary status with a free tool in just a few clicks. FINRA's BrokerCheck functions like the background check for financial advisors and brokers. It's a database run by FINRA, Financial Industry Regulatory Authority, that records the history of licensed financial professionals. This includes stockbrokers, brokerage firms, and also investment advisor representatives. Think of BrokerCheck as your first line of defense to verify that a person is legit and see if they've left any trail of red flags. Go to the BrokerCheck website, brokercheck.finra.org, enter your advisor's name in the search bar, find the correct person in the results. Common names might show multiple entries, so you might need to identify them by their firm or location. Click on your advisor's name to open their BrokerCheck report. Review their profile details, and here's what you'll find. Current registrations. This is crucial. It shows whether the person is registered as a broker with FINRA or as an investment advisor representative with the SEC or state. More on why this matters for fiduciary status in a moment. Employment history. BrokerCheck lists the firms the advisor has worked for, both current and past, and the dates. You can see if they've been with the same company for a long time or if they hop around year after year. Exams and certifications. You can even see what licensing exams they've passed in the detailed report. If you see a Series 65 or 66, that means they've qualified as an investment advisor representative, often a fiduciary role. A Series 6 or 7 means they can sell investment products as a broker. Certifications like CFP, Certified Financial Planner, might be on there too. Disclosures. This is the juicy part, or the scary part. Disclosures are essentially the advisor's rap sheet. Here you'll find the customer complaints, legal disputes, disciplinary action, or regulatory sanctions the person has on record. BrokerCheck will show the number of disclosure events, hopefully 0. If there are any, you can click to read the details. For example, a disclosure might show that the advisor had a settled customer complaint about unsuitable recommendations or a regulatory fine for some misconduct. Not all disclosures are automatic deal breakers. Sometimes even good advisors get an odd complaint, but multiple or serious disclosures are big red flags. BrokerCheck can also show you info on the advisor's firm. If they are registered as an investment advisor, you can find a link to the SEC's IAPD website, where you can find the firm's ADV, specifically the brochure section, where the firm will explicitly state their fiduciary policies. You can find links to FINRA's BrokerCheck and the SEC's IAPD website in the description below. In just these few steps, you've gathered a ton of insight. For instance, you might discover your advisor is only a broker who primarily sells insurance or mutual funds. You might confirm that they're registered as an investment advisor with a flawless record. Or you might find a history of 5 job changes in 5 years with a couple client complaints along the way. Knowledge is power here, and it didn't cost a dime or more than a few minutes. What if you don't find your advisor on BrokerCheck? Double check the spelling and try again. If they truly aren't in the database, it likely means that they're not licensed to sell securities or give investment advice, which is a huge red flag. It could be that they only have an insurance license, which BrokerCheck wouldn't list. Or worst case, they're not licensed at all. In that case, you'd want to dig deeper and definitely question what kind of advice or products they're giving you. Legitimate financial advisors who deal with investments should be on BrokerCheck or the SEC's advisor database. Now that you pulled up the report, let's interpret the most important part. Are they a fiduciary? Here's the key. BrokerCheck won't outright stamp fiduciary or not on the profile, but it gives us clues. The crucial section is the registration and licenses. Look at how your advisor is registered. If your advisor is listed as an investment advisor representative, that's a strong positive. By law, they must act as a fiduciary, meaning they are required to put your interests first when giving investment advice. If they're only listed as a broker, they are paid through commissions and are not full fiduciaries. They must follow regulation best interest, but the standard is simply that recommendations are suitable, not necessarily the best, and conflicts of interest can arise. Many advisors are both. Sometimes they act as a fiduciary, sometimes as a broker, even in the same meeting. This isn't automatically bad, but it makes it critical to ask, will you act as a fiduciary 100% of the time when working with me? A high-quality advisor will give you a clear, direct answer and document it. Beyond the registrations, compensation structure is a big hint. BrokerCheck won't exactly spell out how your advisor gets paid, but you can ask or infer. If the advisor is fee only, the only money they earn is the fee you pay, flat, hourly, or a percentage of assets. They typically don't sell commission products, which removes many conflicts of interest, and they are very likely acting as a fiduciary. Fee-based usually means they can charge fees and can earn commissions from selling products like insurance, loaded funds, etc. This is common with dual registered advisors. It's not automatically bad, but you should be very clear when they're acting as a fiduciary and when they're being paid a commission on a product. Transparency matters. Always know who's paying them and for what. Certain credentials can be positive signals. Advisors with a CFP designation are required by the CFP board to act as fiduciaries when providing financial planning advice, which is a strong indicator of professionalism. That said, don't rely on titles alone. Many designations sound impressive, but do not guarantee fiduciary duty. Always confirm registrations and ask direct questions. At the end of the day, the simplest approach is to ask them directly if they are willing to act as a fiduciary at all times. A true fiduciary advisor will usually say, absolutely yes. Some even sign a fiduciary pledge in writing. If an advisor hesitates, qualifies their answer, or gives you some word salad, that's a red flag. Real quick, here's a summary of all the red flags we've covered today. Unfortunately, we live in a world where, in my view, some Fortune 500 companies appear to make their money by putting their own interest above their clients. They won't be happy about what you've learned in this video. The good news is, it's not all doom and gloom. These free tools can help you choose the right advisor. Here at Caplytica, we focus on giving you the tools and knowledge to manage your own investments. Check out the links in the description, and if you like this video, watch this one next.